I asked ChatGPT a question. Is it a good idea to leave your spouse off your mortgage to save their first time buyer discount so they can buy another house later in their name and use the discount? It's a question that I get asked all the time, and it's interesting what ChatGPT had to say about it. So let's just talk about the output that I got from ChatGPT when I asked that question. My name is Anthony Lindsay, and I've been in finance for over 30 years. I make these videos so that I can share information with you and I can answer your questions. I don't make these videos to replace speaking to a qualified professional because you should never get your advice from some guy on TikTok, your barber, or anyone like that. Always speak to a professional. And when we're talking about mortgages, always remember that your property could be repossessed if you don't keep up the repayments on your mortgage. So let's look at this question. Should I, or is it a good idea to leave your spouse off the mortgage to save their first time buyer's discount so that they can buy another property later on in their name and use the discount? Firstly, what is stamp duty? Stamp duty is a fee that you pay when you're purchasing a property and potentially purchasing land. So when you're purchasing property or purchasing land, you do pay a fee. And if you're a first time buyer, there are some provisions or some instances where you don't have to pay that fee. So what some people want to do is say, well, I'm a first time buyer. My wife or husband is a first time buyer. What I'm going to do is leave them off the property deal or off the mortgage in order to save money. And ChatGPT has a very interesting answer to that question. So, why would someone do it? Is it good or is it a good idea to leave your spouse off the mortgage and or the title to preserve their first time buyer status? It comes with major caveats that you must understand before making the move. Here's a breakdown of the pros and the cons. So firstly, why would someone do it? In the UK, if you're buying a house for the first time and you've never owned any property anywhere in the world, you may be able to qualify for the first time buyer's discount. Now, the thing to remember there is anywhere in the world. Quite often people misunderstand what a first time buyer is. So that caveat of anywhere in the world is an important thing to consider and an important thing to think about. Because I know a lot of people have relocated from other countries, which means they may have a property in their home country or they may have had a property in their home country. So actually, by that definition, what ChatGPT is saying there, that they wouldn't actually qualify for that discount. So things to watch out for. There's a legal and ownership issue here. So if your spouse isn't on the mortgage, then they don't technically own the property. So this can get very messy if, let's just say, one of the parties just isn't happy and then you separate. Quite often people go into these situations always hoping for the best. And when you get married, obviously you hope to get married and be married for a very long time. But if you're entering into a situation where, to avoid stamp duty, you're saying, I'm not going to put the other party on there, what happens if there's marital breakdown? Because that person will not legally have any rights to the property. However, you can put other things in place, which you would speak to a solicitor about. Other things can be put in place, but it can be really messy. And it's something that you'd want to consider in the overall decision on whether or not this is the right thing for you to do. Another point to consider is mortgage responsibility. So mortgage responsibility means that because you're taking out the mortgage in just your name, that means that the other party does not have a obligation to repay it. So that means you'll probably qualify for less. It means that the terms could be different and it will impact your affordability. Let me say that in regular terms. So when you're applying for a mortgage, the affordability is based on the income of everyone on the application. To keep the numbers easy, because I like to make things simple, to keep the numbers easy, let's just say each individual on the application makes £25,000. So that's a combined income of £50,000. That means if we use a basic multiplier, and please, brokers, accountants, don't get on my case about this, but I always like to use a 4 times income multiplier. I've been in the business long enough to know that there are lenders that do higher multipliers, but a conservative view is 4 times the salary. So let's just say both parties are making 25,000 a year combined. That's 50,000. 50,000 times 4 is 200,000. I hope everyone's following me. So you have a combined salary of 50,000. 50,000 times 4 is 200,000. So they can afford a mortgage of 200,000 combined plus their deposit. Let's just say that their deposit is 20,000. So 200,000 plus 20,000 is how much? 220,000. So that means combined they could afford a mortgage of 220,000. However, if you're leaving the other party off the mortgage to try to, I guess, in theory, protect the first time buyer's discount, what that means is only one of the salaries will now be included. Now, 25 times 4 is 100,000, which means you can only afford a house for 100,000 mortgage, and you might still have that 20,000 depending on the lender, because they may not allow the other party to contribute towards the deposit. Do you see what I'm getting at here? So you're creating a situation where you, as they say in America, you cut corners, but you end up buying them. So you now have a lower affordability. You now have a lower capacity to get the mortgage. So you're doing all of this. Remember that you can save on the first time buyer's stamp duty. So there are mortgage responsibility issues. The other issue that you're going to run into is mortgage lender restrictions. Some lenders don't allow this setup if the non-borrowing party will live in the home. Others might ask them to sign a waiver or occupier consent. So what that means in regular terms, if you're not putting your spouse or your wife or your husband on the mortgage solely for the purpose of protecting the first time buyer's discount, you might run into problems, or you will certainly run into problems, because not every lender will allow it. When you're looking for a mortgage, what you want to do is speak to a mortgage broker, speak to me 6 months before you're ready, that we can walk you through all of the criteria, get everything cleaned up. The other thing that you want to do is make sure that you have as much choice as possible, because the benefit of going to a broker is brokers work with lots of different lenders. So if you are entering into a situation where by definition you're limiting yourself, so you're saying, I want to leave my wife or husband off, some lenders don't allow that. So you're going to lose the option of working with those lenders. You'll probably or potentially end up working with a specialist lender. Nothing wrong with that. But the specialist lenders can sometimes have higher fees. So you think you're saving money on the stamp duty. You've now ended up with a mortgage that is maybe at a higher rate, which means it's higher monthly repayments, which means it's costing you real money out of your pocket every single month. The other thing to think about is stamp duty complexity. So stamp duty complexity. So you've done this thing to try to avoid a thing, and it may not work out. It may actually mean that when you go to buy the second property with the other spouse, or the other spouse goes to buy the property, they may not qualify for the discount anyway, because the lender or the HMRC may view that you have interest in another property. So after all that you've done, you end up right back where you were, but kind of in a worse position, because the first home that you got, you didn't get the one that you really wanted because you didn't have the affordability, which means all of this was kind of for nothing. So I did ask the question of ChatGPT, and I've asked it in a way that it should give a nuanced output. So all I'm doing now is explaining or breaking down the answer into real terms. A final thought. It might be something that's legal and it might work, but it's not guaranteed and can break down if HMRC sees through the plan and denies the relief later. The couple breaks up and the non owner partner is left with no legal stake. You die or fall out, and the home goes to someone else. So there's some best practice to keep in mind. Anytime you're taking out a mortgage or any financial type of instrument, always be honest. Never try to skirt around laws. Always be open, always be honest, always provide the details that you know are correct. I found that most people ask about this situation of leaving the other party off the mortgage. It's because they've seen something online, or some online guru or someone who's trying to sell a course has said that this is a great idea. I'm not here to say if it's a great idea or a horrible idea. I'm talking through my understanding of this output from ChatGPT. But a lot of the information that we're going through right now does indicate that it might be a risky thing to do. Not only because, just practically speaking, it adds a layer of complexity that may not be necessary, depending on what part of the country you're buying in. Based on the lower affordability, you may not even reach the threshold where you'd be paying stamp duty anyway. So there's lots of things in there. So the best practice is to think about getting legal advice, especially from a solicitor who understands property and family law. Put a deed of trust in place. If the non-owner contributes, consider affordability and tax planning in full. Don't look at it in isolation. Document everything, especially if you're trying to preserve the first-time buyer status. So consider holistic estate planning. Don't look at just one thing. Speak to someone who's well-versed in these type of things. Also, remember, solicitors are looking at the legal side of things. So when you go to a solicitor, they'll be looking at putting together just legal documents. An accountant will be looking at the numbers, but neither a solicitor or an accountant will understand the criteria for lending for a mortgage. It's not a direct correlation between what an accountant does and what a mortgage broker does, what a solicitor does and what a mortgage broker does. You need each of them in your camp. You need all of them as part of your team. However, do understand that the mortgage broker is a licensed professional who does this every day and will understand the implications and understand the lending criteria that lenders have and consider when offering mortgages. So, should you consider this? Here's my final thought. If you're doing it just to save a few thousand on stamp duty, but you're risking tens or even hundreds of thousands in equity, legal complications, and future tax issues, it's probably not worth it. In short, what you should consider doing is looking at how you can get on the property ladder in a way that is affordable to you, is sustainable to you, and is also well within the guidelines and provisions of the law. My name's Anthony Lindsay, and I do these videos to give you information and answer questions that I get asked pretty much every day as I deal with clients. This information is not designed to be legal advice or financial advice, and it's certainly not designed to replace speaking to a mortgage broker. You'll always want to speak to someone who understands your personal circumstances, your appetite for risk, the goals that you have for yourself and your family. Frequently, I speak to people and I give them an answer that they don't really like. And what people can then do is just go from professional to professional until they get the answer that they want. I always recommend shopping around, and you should always use a broker who comes recommended by friends or family, or you should be looking at reviews. But quite often, brokers will protect you from yourself. So you may not get the answer you want. You may not get that ego boost of, yes, I saw this thing online 9 times out of 10 by some American person who doesn't understand UK mortgages, or from an online influencer who is there to get clicks and views. That's not to say that what they're saying is 100% wrong. That's not to say that it's even partially wrong. It just might not be for you. And if you take that advice and run with it and it all goes pear shaped, you have no one to go back to. Mortgage brokers are regulated by the FCA. We have to make sure that we get you the best product that suits your needs, suits your budgets, and suits your outcome. So always speak to a mortgage broker. I'd recommend that you speak to a mortgage broker at least 6 months before you think you're ready. I have lots of videos talking about that. I appreciate you watching, and make sure that you like, make sure that you subscribe, and make sure that you leave a comment. If you're a mortgage broker or an accountant and you feel like maybe I haven't covered this off well, make sure you put your comments in the comment. And this is a really small channel, so I do appreciate your subscriptions. If you've watched for more than 2 minutes, it's worth subscribing. That way you'll be notified when I come up with new videos, and you'll also have the opportunity to give ideas of things that I can talk about in the future. Thanks for watching, and make sure that you check the link, check the description. If you need a mortgage broker, you can book an appointment. My QR code from my LinkedIn is in the video, and I'd love to talk to you. Thanks for watching.